Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Hello, I'm John Ward on behalf of Physical Gold Fund, and we're delighted to welcome you to the first webinar of 2016 with Jim Rickards in the series we're calling the Gold Chronicles. Jim Rickards is a New York Times best-selling author and the chief global strategist for West Shore Funds. He's the former general counsel of long-term capital management, a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim, and welcome, and Happy New Year.
Happy New Year, John. Good afternoon. Great to be with you.
We also have with us Alex Stanzik, the managing director of Physical Gold Fund. Hello, Alex.
Hi, John. Hi, Jim. Great to be here as always.
Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question. And as time allows, we'll do our best to respond to you. So, Jim, there's been a lot happening since we last spoke, and I'm sure our listeners will be keen to hear your take on the travails of the Chinese stock market, volatility in the US markets, the crisis around Saudi Arabia, and other hot topics. We'll get to as much of that as we can today, but I'd like to start closer to home with some exciting news. You're the author of 2 books, Jim, as I mentioned in my introduction, both of them hugely successful. In April this year, you'll be publishing your 3rd book, and it's called The New Case for Gold. This one had a rather special inception, and I'd like you to share with our listeners how the new book came about, and perhaps more important, why you felt impelled to write about gold at this time.
Great. Thank you, John. I am very, very excited about this new book, and I just want to say for our listeners, this is right now, live on this call, is the first time I've really spoken publicly about it. The book is available for pre-order on Amazon, so it's not like it's some secret. It has a publication date of April 5th, but I haven't, at least not yet, done much in the way of publicity or interviews, and of course I'll be doing all of that in the weeks and months ahead. People will probably be tired of hearing about it at some point, but this is quite literally the first time I've spoken about it, so I'm very happy to share it with this audience, and it does have a special origin. The book is called The New Case for Gold. As I say, it's available for pre-order on Amazon, but there'll be some special editions that I'd like to talk about as well. But the origin of this, first of all, let me just say a word about the title. The title is a little bit of a tribute to an earlier book, 35 years ago actually, called The Case for Gold. And this was something that came from Ron Paul and Lou Lehrman. Of course, in 1980, Ronald Reagan was elected president, and it wasn't that long after President Nixon had gone off the gold standard. You know, President Nixon went off the gold standard in August of 1971. So here we were in 1980. Ronald Reagan's the first Republican president elected since then. And there was a very strong movement at the time to go back to the gold standard. Like I say, we look back now, it's 40 years since Nixon did what he did, actually over 40 years. But when Reagan came in, it had only been 9 years, and so it was still pretty fresh in people's minds. So President Reagan didn't want to endorse the gold standard in so many words, but he did agree to a commission to study it. That's a typical Washington solution when you want to kick the can down the road, so to speak. You have a commission. So they appointed a commission. The commission studied it. They came back with a report. And the conclusion of the committee as a whole, of this commission, was that the United States should not go back to the gold standard. However, as is often the case, the commission was divided, and there was a very strong vocal minority that thought we should go back to the gold standard. So they were allowed to write a minority report, and the leader of that group was Congressman Ron Paul, Dr. Ron Paul at the time, also Lou Lehrman, some others, and they wrote this minority report arguing that we should go back to the gold standard. This became a public record because it was a public commission, so the work was sort of anyone, it was like the public domain, it's like Shakespeare, anybody can print an edition of Shakespeare, you don't have to pay royalties. So this minority report was turned into a book called The Case for Gold. So my book is called The New Case for Gold. Obviously a little bit of a tribute there to the original minority report, but I put the emphasis on the word new because there are arguments in the book and discussion in the book, not just arguments, but I think it's pretty well documented, that there are arguments in favor of investing in gold that transcend or go beyond the sort of the same old arguments we've been hearing about for years. I mean, I'm sure we have a lot of gold investors on the call, on the webinar today, and people like it or they don't like it, or they can see the logic for having some gold in your portfolio, or perhaps they don't. But these debates have been going on and on. They get a little bit tired, and I do cover that in the book. But there are things in the book that are new that were not discussed 35 years ago because they didn't exist. And I'll just give one example. There's a lot in the book. Just to give one example, cyber warfare. Today, people say, "Well, I'm wealthy. I have a certain net worth. Here are my assets." And you say, "Well, that's interesting. So your house, okay, that's real. I can go up and knock on the door. If you have some physical gold, that's real. You can touch it and keep it in a secure place. But stocks, bonds, other money market accounts, bank deposits, those things aren't real. Those are digital. They are electrons in some system that can be erased by Vladimir Putin's cyber brigades. So your digital wealth is extremely vulnerable. I'm not saying sell all your stocks and buy gold. I'm not saying that at all. What I'm saying is just be aware of the risks, and when you talk about having those assets, bear in mind that they are electrons, they are digital, and they can be erased. And that's something that people weren't talking about 35 years ago because cyber warfare didn't exist and the internet didn't exist. And yeah, there was electronic record keeping, but you got paper statements and paper confirmations and a lot of things to back it up. And today, a lot of people are 100% digital. So there are threats out there that didn't exist 35 years ago that add to the argument in favor of gold. So I've got some oldies but goodies. I've got some of the things that some listeners may be familiar with, others less so, but some new arguments, some 21st century arguments in favor of gold, and that's why we call it the new case for gold. Now, John mentioned the origins of this, and the origins are right here on this call. I've been on the advisory board of the Physical Gold Fund for now into our third year. It's been a great relationship. Along the way, we've always thought about what are new and better ways to reach out to interested parties, to whether it's educational, whether it's communications. How can we at Physical Gold Fund do a better job of getting the story out and reaching out to interested parties and helping people either learn more or actually invest in gold if they would like? That was the origin of this podcast series. We said, well, why don't we do a monthly call and invite people to join in and post it as a podcast and make the transcripts available? Well, we did that. We've been doing this for a couple of years now, and what we realized is that looking at the transcripts, we had a lot of material, well over 100,000 words, and a good long book is about 80 or 90,000 words. So we said, well, why don't we turn this into a book? Now, believe me, it's not as simple as taking a bunch of transcripts and sending them to the printers and putting a nice cover on it and calling it a book. We had to do a lot of rewriting. One of the things I discovered in the process is that the way we speak is not the way we write, or at least not the way I write. So things that sound perfectly normal on a call like this, normal conversational English, can look a little clunky when the words are in a row on the printed page. So we smoothed out the rough edges. We removed the redundancies. We added some completely new material. There's stuff in the book that none of our listeners or colleagues have seen because it's completely new, and we're happy about that because this is not just a retrospective. We want to stay on the cutting edge. So it's smoother, it's more polished, it's got brand new material. Candidly, it's got some stuff in it that I think when it comes out will make some headlines, some things that I've never heard before. I've been very involved with gold, but in the course of doing the research and thinking about this, we developed some new things that I think will shake the gold world quite a bit. So, and then on top of that, that's all if this were just any book coming out from my book publisher, Penguin, but Physical Gold Fund has arranged with my publisher, with Penguin, a special edition. I'll leave it to them to describe the marketing channels for that, but I've contributed some material to that will only appear in that Physical Gold Fund edition. So whether you want to pre-order from Amazon right now, or wait till it's in your bookstore, or wait to hear more from Physical Gold Fund about how they intend to distribute their special edition, I leave all that to the listeners, but very, very excited about the book. The publication date is April 5th, so not that far away. Some channels may get a couple copies early, depending on how they work. I'll leave that to my publisher, but it's coming. It's new. It's a very exciting project. I'm very happy with the way it came out. I thought my publisher did a great job with the cover. It's not like flat mustard yellow. It looks like a nice bar of gold, so hopefully it'll catch readers' attention. So very excited about it. Looking forward to it coming out on April 5th.
Well, thanks, Jim. And actually, thanks to our listeners, because your participation in these podcasts, your great questions, your involvement and presence to keep us going with this has actually made this whole thing possible. So you should see yourselves as participants in this new book project. So, Jim, turning to China, the last time we talked about a sudden crash in the Chinese stock markets, you warned us on this podcast, don't expect it to end here. Those are prescient words. Chinese markets continue to be in turmoil, and now the US markets seem to be losing their nerve. My question is, are we simply seeing more of the trends that you've outlined for us before, or is something new emerging here?
It's really both, John. Just to talk about the trends a little bit. So we see the Chinese stock market going down, and we see the U.S. stock market going down. Now, there are things that international economists call spillovers or complexity theorists call contagion. So there are certainly linkages between these markets, but I don't want to suggest it's just a reflex reaction. They go down, we go down. It's as simple as that. The fact is, let's look at the fundamentals first, and then let's come back to some of the more technical factors. The fundamentals are world growth is slowing down rapidly. It's whether there's a global recession in 2016, I would not rule that out. But even if it's not technically a recession, this slowdown it feels like a recession. In other words, what's the difference if you go from 4% to 2%? Or go from 2% to 0, maybe one of them is technically a recession, the other one isn't, but both of them represent a very sudden slamming on the brakes and a very significant diminution of global growth. So even if you're in positive territory in terms of growth, when you slow down that much, it feels like a recession around the world. The U.S. may actually be in a recession. If not, we're uncomfortably close to one or maybe heading for one. You know, we have something called the National Bureau of Economic Research in Cambridge, Massachusetts, and they're the referees. They're like umpires in a baseball game who call balls and strikes. They're the ones who decide officially when we're in a recession or not. But the problem is they're eggheads. I mean, they're PhD economists by and large, and they don't usually tell you you're in a recession until you're almost out of it. In other words, a year from now, the National Bureau of Economic Research may say, we studied things closely and we decided that the U.S. economy went into a recession in January 2016. Well, thank you very much, but you're a year late. As analysts and as investors, we need to operate in a little closer to real time. So I'm not waiting for them to call strike three here. It looks like a recession to me. Certainly there's a lot of data that indicates that. So it should come as no surprise that stock markets are going down. That's what stock markets do. Stock markets discount the future. They go down in advance of a recession, generally speaking. And so if we're heading for a recession, which I believe we are, the fact that stock markets are going down now makes perfect sense. It's not the end of the world. It's not some awful, unprecedented thing. I think people, because it's been 8 years since the last recession, and since it's been 8 years since stock markets went down in any kind of sustained way, people forget. Memories are short, and there's a lot of wishful thinking, a lot of denial, and people forget that these things happen. This expansion, let's just talk about the expansion for a minute, which began in the summer of 2009, has been going on for 7 years, and 6.5 years, and the point is, this is one of the longest expansions ever. Now, it hasn't been a great expansion. We've had sort of 2% growth, which is a far cry from the 3.5% growth, or even sometimes 4-5% growth that we're used to in expansions. So it's been a very weak, anemic expansion, but an expansion nonetheless. And it's 79 months old. The average expansion since 1980 is only 76 months. The average expansion since the end of World War II, longer time frame, is about 38 months. So this is kind of a grandfather type expansion in terms of its longevity, and that doesn't mean that by itself doesn't say you're in a recession. Expansions don't die of old age, but should come as no surprise if it does die, because it's been around so long. Combine that with all the other factors we're seeing, world trade contracting, manufacturing contracting, commodity prices collapsing, China slowing down, Russia's in a recession, Japan's in a recession, Brazil's in a recession, Canada looks close to one. This is a global story, and it does look like the U.S. is heading into a recession. So therefore, I look at the stock market and say, well, you're doing what you're supposed to do. I'm not a stock picker. I'm more of a global macro analyst, but this should really come as no surprise. So that's the first thing I would say. Now, as far as the technical linkages are concerned, see, the Chinese have their own problems. The Chinese are I gave a couple interviews last week, and I said, people forget that they're communists, and I don't say that as kind of a name-calling, finger-pointing exercise. They are communists. It's the Communist Party of China. That's who runs the country. Putting communists, everyone says, well, they're really capitalists. Well, no, they're really communists who have a quasi-modified capitalist system. They've got some markets, but at the end of the day, those markets exist under an umbrella of communist top-down central planning and control. So I like to say when you put communists in charge of a market economy, it's like handing a loaded gun to a 3-year-old. Somebody's going to get hurt. In other words, they actually don't know what they're doing. They think they do, and but they're kind of stumbling and bumbling their way through this. And for concrete examples of that, you just have to look no further than the Chinese devaluation of last August, which was a complete shock. Now, anyone who knows anything about international economics or the international monetary system knows that when you're going to do something like a devaluation, you don't shock people, you don't spook people. You sort of you indicate it, you leak it, you do it in baby steps, you do it in such a way that it doesn't shock or disrupt the markets, but that lesson seems not to have sunk in. And then, of course, you look at the circuit breakers they had until last week. These were binary circuit breakers. So if the stock market, if the Shanghai Exchange Index went down a certain amount, they closed the market. Boom, just like that for the whole day. Now, that's not what circuit breakers are designed to do, and that's not how circuit breakers work in the United States. In the United States, the New York Stock Exchange, it goes down a certain amount. They will close it for a short period of time. Then they reopen it, and they see what happens. If it bounces back, great. If it goes down again by another amount, they will close it again for a certain period of time, and so on. And then finally, if after a certain number of times, if it's sufficiently late in the day, they will close it for the rest of the day. But that doesn't happen until it's already shut several times, until you're much closer to the end of the day. The point is, the circuit breakers are not designed to keep the market from going down, because if it's going to go down, it's going to go down. The circuit breakers are a timeout so people have time to think. So you can break that cascade or break that panic reaction of everyone selling, and that drives it down, and they sell more, and it drives it down, and they sell more, and it drives it down. It just kind of cascades out of control. By calling a timeout, it gives people to think, maybe I like it here. Maybe this is a good level. Maybe it's not going to go down more. Maybe somebody can say something reassuring, or Fed governor can give a speech, whatever it might be. But that's why you have circuit breakers. It's a timeout. Well, the Chinese weren't really using it as a timeout. They were just closing the market for the day, and then that just caused more panic, and of course the same thing would happen the following day. So they got rid of their circuit breakers. They'll probably come back with new and improved ones, but my point being, looking at how they bungled the currency devaluation in August and looking at how they bungled the circuit breakers in January shows you that they don't really understand how markets work, that they're amateurs at this, and as I say, it's like a child playing with a loaded gun. There's going to be some damage, and indeed we are seeing damage. Now, as far as where these trends are going, because you start the question with a comment about trends, John, China is facing something that international monetary economists call the impossible trinity, and I'll just explain it briefly. I don't want to spend a whole lot of time on it, but the impossible trinity says there are three things you cannot have at the same time. You can have one or two, but you can't have all three. The three things are an open capital account. That means people can get money in and out. A pegged exchange rate, so you're trying to preserve some value for your currency relative to something else. An independent monetary policy, which means you're preserving the right to raise or lower your interest rates as you see fit. So three things: open capital account, pegged exchange rate, independent monetary policy. The impossible trinity says you cannot have all three. If you try, you will fail. So whenever you see a country trying to do this, you can be sure they're going to fail. And then the only question is, how will they fail and when? Well, up until last summer, China was trying to do this. They were trying to do the impossible trinity. By the way, there's nothing new about this theory. It was articulated by Robert Mundell, Nobel Prize-winning economist, in the early 1960s. So this theory's been around for 55 years. I don't know what the Chinese have been reading, but they tried to do it. They tried to peg to the dollar at 6.2 to 1. They tried to have an open capital account so they could get in the SDR basket for the IMF, because that was one of the conditions. And they wanted an independent monetary policy so they could cut interest rates if they needed to stimulate their economy. So open capital account, pegged exchange rate, independent monetary policy, they were trying to have all three. Theory says it can't be done, and sure enough, it wasn't. They broke the peg in August. They slapped on sort of makeshift capital controls, and the one thing they have kind of hung on to is independent monetary policy. They are reserving the right to cut interest rates. They probably will do that. You can't, as I say, you can't have one or two of these. You just can't have all three. As a result of that, I would expect the Chinese devaluation to continue because they have no other choice. Their reserves are running out the door at the rate of $1 trillion a year. They're losing reserves at the rate of $1 trillion a year. When you start with $4 trillion, it sounds like a lot of money, but if you're losing $1 trillion a year, guess what? In 4 years, you're broke, and then I think that actually that tempo, they don't do anything, will accelerate, so they'll be broke, I estimate, by the end of 2017, if not sooner. So they're not going to sit there and let that happen. They're not going to let all that money run out the door. So what they're doing is devaluing the currency, and then they may, as I say, they may put on some capital controls. Now, they may cut interest rates. They may do kind of deal with all three legs of the impossible trinity. So what does that mean for us? Well, if they're going to continue to devalue, what does that do? It exports deflation to the United States. What does that do? It makes it harder for the Fed to reach its inflation goals. What does that mean? Well, really, the Fed's going to raise rates. The Fed wants inflation. Raising rates makes the dollar stronger, imports deflation. China's cutting the exchange rate, which imports more deflation. So all the trends are deflationary, but the Fed says they want inflation. So how does that play out? Well, my estimate is that the Fed was not going to be able to stay on track in terms of raising interest rates. So I think they will raise in March, maybe June. I'll keep an eye on June, but I'm pretty confident that they will raise in March because they're not listening to this call. I don't think Janet Yellen's on the call. My point being, the Fed doesn't look at the real world. They look at models. Their models tell them that inflation is right around the corner and growth is robust. Meanwhile, back in the real world, all we see are signs of deflation and probable recession. So the Fed will be the last to know, but probably by the summer they'll wake up. But the problem with cutting interest rates in, let's say, September. So let's say they raise in March and they raise in June. I definitely expect March, and I think June is likely. At that point, the target Fed funds rate will be 75 basis points, and they would be in a position to cut by September when, by then, even the Fed should understand how weak things are. But there's another problem, which is that you're 60 days ahead of the election, actually 45 days ahead of the election when the September FOMC meeting comes around. So what are they going to do, cut interest rates 45 days before the election? Ted Cruz will go burn down the Fed. I mean, the point being, that would be such a blatantly political move favoring the Democratic nominee that I don't think the Republicans will let him get away with it. And the last thing the Fed wants is political, crossfire because they're already under a criminal investigation for insider trading. So I think that if we get to September, the economy is as weak as I expect. The Fed has raised interest rates in the face of weakness, which is a blunder, and they decide to reverse course. They actually won't be able to reverse course for political reasons. They may go to some kind of forward guidance. So these things are all connected. China's got their problems with their capital account being depleted and the impossible trinity and the need to devalue. The U.S. has its problems with a central bank that doesn't live in the real world and is raising rates into weakness. The U.S. and China together are about 1/3 of the global economy, a little more actually, and if they're both slowing down, what does that mean for the global economy? Well, look for a global recession in 2016.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.